Question 1. Regulation and licensing of captive insurance companies in Nebraska. Which of the following is not a requirement for establishing a captive insurance company in Nebraska? A. The company must maintain a minimum surplus in capital as defined by Nebraska law. B. The company must submit a detailed business plan including actuarial reports and financial projections. C. The company must obtain approval from the Nebraska Department of Insurance before beginning operations. D. The company must operate in a state outside Nebraska before establishing operations in Nebraska. Answer: D. The company must operate in a state outside Nebraska before establishing operations in Nebraska. Explanation: according to the Nebraska Captive Insurance Act, a captive insurance company must comply with the state's minimum capital and surplus requirements, submit a business plan that includes actuarial reports and financial projections, and obtain approval from the Nebraska Department of Insurance before operating. There is no requirement for a company to first operate outside Nebraska before establishing operations within the state. Question 2. Captive insurance operations. A captive insurance company is considering the use of reinsurance to help manage its exposure to high-risk claims. Which of the following is a primary advantage of a captive using reinsurance? A. It allows the captive to reduce the premiums paid for insurance. B. It enables the captive to increase its capital base without additional financial backing. C. It provides the captive with a means to spread risk to other insurers and reduce potential losses. D. It eliminates the need for the captive to maintain an actuarial reserve for future claims. Answer: C. It provides the captive with a means to spread risk to other insurers and reduce potential losses. Explanation: reinsurance is a critical risk management tool for captives, allowing them to transfer part of their risk exposure to other insurers. This helps to spread the risk, particularly for large or catastrophic claims, thus reducing the potential for significant losses. It does not directly impact premiums or capital in the way described in the other options. Question 3. Scenario-based question: captive insurance contracts. Mr. Lee is the CEO of a captive insurance company formed under the Nebraska Captive Insurance Act. His company provides liability coverage to a group of manufacturing businesses. Recently, one of the policyholders, a manufacturer, filed a claim for a product liability incident. Upon investigation, Mr. Lee discovers that the incident occurred after the policyholder had made unauthorized modifications to the product in question, which may have violated the terms of the policy. Given this information, what is the best course of action for Mr. Lee and his captive insurance company? A. Deny the claim based on the policy exclusion related to unauthorized modifications and inform the policyholder that no coverage will be provided. B. Offer a settlement to the policyholder to avoid litigation, as the claim is not explicitly excluded by the terms of the policy. C. Accept the claim in full, as the product was initially covered under the policy and no exclusions apply to modifications. D. Seek a court ruling on the validity of the claim, as the unauthorized modifications are ambiguous and not clearly addressed in the policy. Answer: A. Deny the claim based on the policy exclusion related to unauthorized modifications and inform the policyholder that no coverage will be provided. Explanation: in captive insurance contracts, policyholders are typically subject to the terms and exclusions outlined in the policy. If the policy includes an exclusion for unauthorized modifications, then Mr. Lee's best course of action is to deny the claim. This ensures compliance with the terms of the policy and protects the financial stability of the captive. Offering a settlement or accepting the claim without addressing the policy's exclusions would violate the terms of the contract, and seeking a court ruling would only delay the decision without a clear benefit. Question 4. Financial requirements and solvency standards. Which of the following is true regarding the solvency requirements for captive insurance companies in Nebraska? A. Captive insurance companies are not required to maintain solvency reserves as long as they are adequately capitalized. B. Captives must submit an actuarial report annually to demonstrate their solvency and reserve adequacy. C. Nebraska does not require captives to submit any financial disclosures to the Nebraska Department of Insurance. D. Solvency standards only apply to traditional insurance companies, not captives. Answer: B. Captives must submit an actuarial report annually to demonstrate their solvency and reserve adequacy. Explanation: under Nebraska's regulatory framework, captive insurance companies are required to maintain solvency and ensure they have adequate reserves to cover future claims. One key requirement is the submission of an annual actuarial report to demonstrate that the company has sufficient reserves and is financially stable. This is essential for ensuring that captives can fulfill their obligations to policyholders. Captives are also required to disclose their financial condition to the Nebraska Department of Insurance. Question 5. Captive insurance contracts. Which of the following is the most likely reason for including exclusions in a captive insurance policy? A. To reduce the premiums of the policyholder by limiting coverage. B. To ensure that the captive's capital reserves are only used for claims that meet the terms of the policy. C. To ensure that the captive does not pay for any losses that are covered under other insurance policies. D. To make the policy more attractive to potential policyholders by offering extensive coverage. Answer: B. To ensure that the captive's capital reserves are only used for claims that meet the terms of the policy. Explanation: exclusions in a captive insurance policy are designed to protect the captive from assuming liability for certain types of risks that are outside the scope of the policy's coverage. By limiting the coverage to specific types of claims, exclusions ensure that the company's capital reserves are only used to cover claims that are deemed appropriate under the policy. This protects the financial stability of the captive. While exclusions may indirectly influence premiums, they are not primarily used for this purpose. Question 6. Emerging issues and trends in captive insurance. How has the increasing use of technology, such as InsurTech and artificial intelligence (AI), impacted captive insurance companies? A. Technology has decreased the need for regulatory oversight in captive insurance operations. B. Technology has made underwriting and claims handling more efficient by automating tasks and enhancing data analysis. C. Technology has made it more difficult for captives to assess their risk exposure due to increased complexity in data. D. Technology has rendered captive insurance obsolete, with many companies opting for traditional insurance models instead. Answer: B. Technology has made underwriting and claims handling more efficient by automating tasks and enhancing data analysis. Explanation: technology, particularly InsurTech and AI, has significantly impacted captive insurance companies by improving operational efficiency. Automation of underwriting, claims handling, and risk analysis allows captives to process data more quickly and accurately, reducing administrative costs and improving decision-making. While technological advancements create new challenges, such as regulatory adjustments and data security concerns, they are not making captives obsolete or complicating risk assessments. Question 7. Risk Retention GRGs and their role. What is the main difference between a risk retention GRG and a traditional captive insurance company in Nebraska? A. An RRG is limited to offering insurance only to its members, while a captive can offer coverage to unrelated entities. B. An RRG is subject to state regulations in the state where it is domiciled, while a captive is governed solely by federal regulations. C. An RRG can only provide coverage for risks that are entirely within the state of Nebraska, while a captive can provide nationwide coverage. D. A traditional captive can offer coverage to unrelated parties, while an RRG is limited to offering coverage to a specific industry group or association. Answer: A. An RRG is limited to offering insurance only to its members, while a captive can offer coverage to unrelated entities. Explanation: the key difference between a risk retention GRG and a traditional captive insurance company is that an RRG is restricted to offering insurance exclusively to its members who share a similar risk profile, such as a specific industry group or profession. In contrast, a traditional captive insurance company can provide coverage to both related and unrelated parties, allowing it more flexibility in its operations. ROGs are subject to federal law, Liability Risk Retention Act of 1986, but must also comply with state regulations in their domicile. Question 8. Corporate governance in captive insurance. Which of the following is true about the corporate governance responsibilities of directors and officers in a captive insurance company? A. Directors and officers of a captive are only responsible for ensuring that the company generates profit, not for compliance with regulatory standards. B. Directors and officers are required to act in the best interests of the company, ensuring proper risk management and compliance with regulations. C. The corporate governance structure of a captive insurance company is the same as that of a traditional insurance company, with little difference in roles and responsibilities. D. Directors and officers of a captive insurance company can delegate their compliance responsibilities entirely to third-party service providers. Answer: B. Directors and officers are required to act in the best interests of the company, ensuring proper risk management and compliance with regulations. Explanation: Directors and officers of a captive insurance company have fiduciary duties to act in the best interests of the company, which includes ensuring effective risk management, regulatory compliance, and financial stability. It must also ensure that internal controls are in place to safeguard the company's operations. While outsourcing functions like underwriting or claims handling is common in captives, directors and officers cannot fully delegate compliance responsibilities as they remain accountable for the company's overall governance. Question 9. Captive insurance taxation. Which of the following is true regarding the federal tax treatment of captive insurance companies? A. Captive insurance companies are not eligible for tax deductions on premiums paid to reinsurance companies. B. Captive insurance companies may deduct premiums paid for coverage they provide to related parties, subject to IRS scrutiny. C. Captive insurance companies are fully exempt from paying federal taxes on their premiums and investment income. D. Captive insurance companies cannot apply to become tax exempt under IRS guidelines for risk retention purposes. Answer: B. Captive insurance companies may deduct premiums paid for coverage they provide to related parties subject to IRS scrutiny. Explanation: under federal tax law, captive insurance companies are allowed to deduct premiums paid for coverage provided to related parties, but these deductions are subject to scrutiny by the IRS. The IRS has issued guidelines to ensure that captives are not being used as a tax avoidance strategy, and premiums must be structured based on arm's length pricing and actuarial standards. While captives can take tax deductions, they are not exempt from federal taxes on their premiums or investment income. Question 10. Financial requirements and solvency standards. What is the role of actuarial reports in assessing the solvency of a captive insurance company? Actuarial reports are used to predict the potential profitability of a captive insurance company. B. Actuarial reports are used to assess whether a captive reserves are adequate to cover anticipated future claims. C. Actuarial reports only assess the capital needs of the company and do not consider claims or risks. D. Actuarial reports are used exclusively for tax purposes and do not impact the company's solvency assessment. Answer: B. Actuarial reports are used to assess whether a captive's reserves are adequate to cover anticipated future claims. Explanation: actuarial reports play a crucial role in evaluating the solvency of a captive insurance company. These reports assess whether the company's reserves are sufficient to meet future claims, taking into account factors such as loss history, expected claim frequency, and severity. The actuarial report is a key tool in ensuring that the captive maintains financial stability and meets regulatory solvency requirements. While it can inform profitability, its primary purpose is to ensure that the company's reserves are adequate. Question 11. Regulatory oversight in captive insurance. What is the primary purpose of the Nebraska Department of Insurance in regulating captive insurance companies? A. To monitor the profitability of captive insurance companies and ensure they provide maximum returns to shareholders. B. To ensure that captive insurance companies are financially solvent, operate in compliance with state laws, and meet the needs of their policyholders. C. To limit the number of captive insurance companies operating in the state in order to protect the interests of traditional insurers. D. To provide tax incentives for captive insurance companies that operate in Nebraska. Answer: B. To ensure that captive insurance companies are financially solvent, operate in compliance with state laws, and meet the needs of their policyholders. Explanation: the Nebraska Department of Insurance's primary role is to oversee the solvency and regulatory compliance of captive insurance companies. This includes ensuring that captives maintain adequate reserves to cover claims and that they adhere to state regulations. It also protects policyholders by monitoring the financial stability of captives and ensuring that they operate transparently and within the law. Question 12. Captive insurance capital requirements. Which of the following is the minimum required capital for a captive insurance company in Nebraska? A. $500,000 for a single parent captive. B. $1 million for a single parent captive and $2 million for group captives. C. $500,000 for all types of captives, regardless of structure. D. There is no minimum capital requirement for captives in Nebraska. Answer: B. $1 million for a single parent captive and $2 million for group captives. Explanation. In Nebraska, the minimum capital requirements for captive insurance companies vary based on the type of captive. A single parent captive is required to have a minimum capital of $1 million, while group captives, which involve multiple entities, must maintain at least $2 million in capital. These requirements are designed to ensure that captives have sufficient financial resources to cover claims. Question 13. Risk management in captive insurance. Which of the following is a key advantage of using a captive insurance company for risk management? A. Captives allow businesses to transfer all of their risk to a third-party insurer. B. Captives provide more predictable premiums by allowing businesses to better control their risk exposure. C. Captives eliminate the need for reinsurance. D. Captives always provide lower premiums than traditional insurance. Answer. B. Captives provide more predictable premiums by allowing businesses to better control their risk exposure. Explanation. One of the main advantages of forming a captive insurance company is that it allows businesses to have more control over their risk management. By pooling risk and providing tailored coverage, captives can provide more predictable and stable premiums. While captives may not eliminate the need for reinsurance, they offer greater flexibility in managing risk and can often result in more cost-effective premiums over time. Question 14. Captive insurance types. What distinguishes a pure captive insurance company from other types of captives? A. A pure captive provides insurance coverage solely for its parent company and its affiliates. B. A pure captive can offer insurance to unrelated third-party businesses. C. A pure captive can only provide insurance coverage for risks within a specific industry. D. A pure captive is required to cover a wide variety of risks for unrelated policyholders. Answer A. A pure captive provides insurance coverage solely for its parent company and its affiliates. Explanation. A pure captive insurance company is owned by one parent company and provides coverage exclusively for that company and its affiliates. Unlike group captives or renter-captives, which may provide coverage for unrelated businesses, a pure captive's risk pool is limited to the parent organization's risks. This allows for more direct control over risk management and premiums. Question 15. Captive insurance tax deductions. Which of the following is the IRS requirement for a captive insurance company to be eligible for tax deductions on premiums? A. The premiums must be paid to a captive owned by the policyholder's competitors. B. The premiums must be paid for insurance coverage provided to unrelated third-party entities. C. The premiums must be actuarially sound, with the risk being adequately transferred from the policyholder to the captive. D. The captive must insure at least 75% of risks within a single geographic region. Answer. C. The premiums must be actuarially sound, with the risk being adequately transferred from the policyholder to the captive. Explanation. For a captive insurance company to be eligible for tax deductions, the premiums paid to it must be considered legitimate under IRS rules. This means that the premiums must be actuarially justified and the risk transferred to the captive must be substantial enough to warrant the tax deduction. The IRS closely scrutinizes captives to ensure that they are not being used for tax avoidance purposes. Question 16. Insurance lines in captive insurance. Which of the following types of coverage is typically offered by a captive insurance company? A. Homeowners insurance for individual policyholders. B. Commercial property and casualty insurance for related entities. C. Life insurance for employees of unrelated businesses. D. Health insurance for employees of unrelated businesses. Answer. B. Commercial property and casualty insurance for related entities. Explanation. Captive insurance companies primarily provide commercial property and casualty insurance coverage for related entities, often tailored to the specific risks of the parent company or its affiliates. While captives can offer a wide range of coverages, they typically do not offer personal lines like homeowners insurance or life and health insurance for unrelated entities. Question 17. Captive insurance liability. What type of liability is typically excluded from coverage by a captive insurance company? A. Liability for damage to the captive's own property. B. Liability for claims arising from intentional acts or fraud. C. Liability for negligence committed by an employee of the captive. D. Liability for risks insured under other third-party policies. Answer. B. Liability for claims arising from intentional acts or fraud. Explanation: captive insurance companies generally exclude coverage for liabilities arising from intentional acts or fraud, as these are typically not insurable risks. Captives are designed to cover business risks such as property damage, general liability, and other operational risks, but intentional misconduct and fraudulent acts are usually excluded from coverage under most captive policies. Question 18. Group captives. Which of the following is an advantage of a group captive insurance company? A. It allows businesses to pool their risks and share the cost of insurance premiums. B. It allows individual businesses to have complete control over their insurance underwriting and claims management. C. It eliminates the need for reinsurance. D. It offers coverage only to a single company within the group. Answer A. It allows businesses to pool their risks and share the cost of insurance premiums. Explanation: a group captive insurance company allows multiple businesses to pool their risks and share the costs of premiums. This type of captive provides more risk diversification, potentially lowering the cost of coverage for all participants. Group captives are especially beneficial for small or medium-sized businesses that may not have the resources to establish their own individual captive insurance companies. Question 19. State regulation of captive insurance. Which of the following is the role of the state in regulating the formation of a captive insurance company? A. The state does not regulate captive formation. It is solely up to the IRS to determine tax eligibility. B. The state requires captives to submit a detailed business plan and obtain approval before formation. C. The state determines the exact pricing of premiums for captives, ensuring that they are competitive with the market. D. The state only regulates the licensing of captives after they have been formed and are operating. Answer: B. The state requires captives to submit a detailed business plan and obtain approval before formation. Explanation: before a captive insurance company can be formed, the state requires the submission of a detailed business plan outlining the purpose, financial projections, and operational plans of the company. The state reviews these documents to ensure that the captive will be financially sound and compliant with state laws. This is an essential step in the regulatory process of captive formation. Question 20. Captive insurance industry growth. What has contributed most to the growth of captive insurance companies in recent years? A. Increased regulatory restrictions on traditional insurers. B. The ability to control insurance costs and customize coverage for specific risks. C. The availability of low premiums for unrelated third-party businesses. D. The expansion of insurance lines covered by captives, including health insurance. Answer: B. The ability to control insurance costs and customize coverage for specific risks. Explanation: the growth of captive insurance companies has largely been driven by businesses' desire to control insurance costs and tailor coverage to their specific needs. Captives allow businesses to assume some of their own risks and gain more flexibility in managing insurance claims. This level of control and customization is especially valuable in industries with unique or high-risk exposures. Question 21. Captive insurance reporting requirements. What is a key annual reporting requirement for a captive insurance company in Nebraska? A. Submission of a detailed financial statement and annual audit report. B. Reporting of all claims handled by the captive in the past year. C. Submission of a market comparison showing captives' premium rates versus traditional insurers. D. Annual report of the parent company's overall profits and losses. Answer A. Submission of a detailed financial statement and annual audit report. Explanation: captive insurance companies in Nebraska are required to submit a detailed financial statement and an audited report each year. This ensures that the company remains financially sound and in compliance with regulatory requirements. The Department of Insurance reviews these reports to assess the captive's solvency and operational performance. Question 22. Reinsurance in captives. What is the role of reinsurance for a captive insurance company? A. Reinsurance is used to increase the premiums collected by the captive from third parties. B. Reinsurance helps a captive manage risk by transferring a portion of the risk to another insurer. C. Reinsurance is not allowed in captives as they are intended to retain all of their risk. D. Reinsurance allows captives to provide insurance coverage for personal lines of business. Answer: B. Reinsurance helps a captive manage risk by transferring a portion of the risk to another insurer. Explanation: reinsurance is an important risk management tool for captive insurance companies. It allows captives to transfer part of their risks to a third-party reinsurer, helping them manage their exposure to large claims and protect their financial stability. Reinsurance can also provide additional capital and liquidity to the captive. Question 23. Captive insurance structure. Which of the following is a characteristic of a protected cell captive insurance company? A. It allows for the segregation of assets and liabilities between different cells, ensuring that one cell's risks do not affect another. B. It is a type of captive that only insures a single entity's risks. C. It must insure only risks related to healthcare or employee benefits. D. It is prohibited from offering reinsurance services to other captives. Answer A. Allows for the segregation of assets and liabilities between different cells, ensuring that one cell's risks do not affect another. Explanation. A protected cell captive allows different businesses or entities to operate separate cells within the same captive. Each cell has its own assets and liabilities, and the risks of one cell are isolated from the others. This structure enables businesses to benefit from a shared captive insurance company while maintaining financial segregation for each entity's risks. Question 24. Captive insurance and IRS regulations. What is a key factor that the IRS considers when evaluating whether a captive insurance company is eligible for tax deductions? A. Whether the captive provides coverage for at least 3 unrelated businesses. B. Whether the premiums paid to the captive are actuarially reasonable and cover a legitimate risk. C. Whether the captive operates as a non-profit organization. D. Whether the captive is licensed in more than one state. Answer. B. Whether the premiums paid to the captive are actuarially reasonable and cover a legitimate risk. Explanation. For a captive insurance company to qualify for tax deductions, the IRS requires that the premiums paid to the captive be actuarially sound and commensurate with the actual risks being transferred. This ensures that the captive is functioning as a legitimate insurance company and not as a tax avoidance vehicle. Question 25. Captive insurance and solvency. Which of the following is a key factor that regulators assess when evaluating the solvency of a captive insurance company? A. The captive's compliance with federal insurance regulations. B. The amount of premium income the captive receives annually. C. The adequacy of the captive's reserves to pay for future claims. D. The number of unrelated businesses insured by the captive. Answer. C. The adequacy of the captive's reserves to pay for future claims. Explanation. Solvency is a critical concern for regulators, and one of the primary factors they evaluate is whether a captive has sufficient reserves to cover its future liabilities. Regulators require captives to maintain adequate reserves to ensure they can meet claims and maintain financial stability. Question 26. Captive insurance structure. Rent-a-captive. What distinguishes a rent-a-captive from a traditional captive insurance company? A rent-a-captive allows businesses to rent insurance coverage from an established captive without creating their own separate entity. B. A rent-a-captive is only available to large corporations with international operations. C. A rent-a-captive is required to insure unrelated third parties. D. A rent-a-captive operates as a mutual insurance company, providing coverage to all its members. Answer A. A rent-a-captive allows businesses to rent insurance coverage from an established captive without creating their own separate entity. Explanation. A rent-a-captive is a facility that allows businesses to rent insurance coverage from an existing captive insurance company. This structure provides smaller businesses or those that do not have the resources to establish their own captive with access to the benefits of a captive insurance model. Unlike traditional captives, rent-a-captives are not owned by the renting businesses. Question 27. Group captives and risk sharing. In a group captive, how are risks typically shared among participants? A. Each participant assumes full responsibility for their own claims. B. Risks are pooled together, with each participant sharing the cost of claims based on their proportional contribution. C. Risks are transferred to a third-party insurer and the group members share the premiums. D. Each participant is only responsible for a fixed percentage of claims regardless of their contribution. Answer. B. Risks are pooled together, with each participant sharing the cost of claims based on their proportional contribution. Explanation. In a group captive, risks are pooled among all participants and the cost of claims are shared based on each participant's proportional contribution. This model allows smaller businesses to share the financial burden of claims while benefiting from the group's collective bargaining power for better pricing and coverage options. Question 20. Captive insurance in Nebraska. Formation process. What is the first step in forming a captive insurance company in Nebraska? A. Submitting a certificate of incorporation to the state. B. Obtaining approval from the Nebraska Department of Insurance. C. Providing proof of insurance coverage from a third-party provider. D. Establishing a risk management committee to oversee operations. Answer: B. Obtaining approval from the Nebraska Department of Insurance. Explanation: the formation of a captive insurance company in Nebraska requires approval from the Nebraska Department of Insurance before any operations can begin. This approval process includes submitting a business plan, financial projections, and other required documentation to ensure the captive will operate in a financially sound and compliant manner. Question 29. Captive insurance tax benefits. What is one of the main tax benefits of forming a captive insurance company? A. Captives are exempt from paying state and federal income taxes. B. Premiums paid to a captive are generally tax deductible as a business expense for the parent company. C. Captives receive special tax exemptions for insuring third-party entities. D. Captives do not have to file tax returns if they operate in more than one state. Answer: B. Premiums paid to a captive are generally tax deductible as a business expense for the parent company. Explanation: one of the primary tax benefits of forming a captive insurance company is that the premiums paid to the captive are generally tax deductible as a business expense for the parent company. This allows the business to reduce its taxable income, making captives an attractive option for businesses looking to manage their insurance costs while benefiting from tax deductions. Question 30. Captive insurance. Types of coverage. Which of the following types of coverage are commonly provided by captive insurance companies? A. Health insurance for policyholders' employees. B. Workers' compensation, general liability, and property insurance. C. Life insurance for policyholders' shareholders. D. Personal auto insurance for individuals. Answer: B. Workers' compensation, general liability, and property insurance. Explanation: captive insurance companies typically provide coverage for commercial lines such as workers' compensation, general liability, and property insurance. These types of coverage are tailored to the specific needs of the parent company and its affiliates, helping to manage risks associated with business operations.